historical rates of return, Wall Street's dirty little lie, and how retirement savers still fall for it every day. Hi, I'm Bruce Whitey. I'm the host of Straight Talk Wealth Radio, heard in Southern California for the last 3 years on AM broadcast radio, and we are expanding to many, many different markets across the country. Listen locally for Straight Talk Wealth Radio. Today, I want to talk to you about two types of earning or investing and how to measure their outcome or performance. The first one is variable investing, which is anything that can go up and down in value. And mistakenly, that often gets measured in terms of average rates of return. And then there's compound growth or compound interest. And that's just a very simple formula in order to measure it. And it just builds interest a little bit every year. So let's look at the difference between these two and their potential. I want to start with the miracle of compound interest and why it was that Albert Einstein was credited with saying that compound interest was the most powerful force in the universe. That's quite a statement coming from a physicist like him. Thanks, Al. Okay, let's talk about the Rule of 72. Now, this is a key formula. I am still amazed all the time how many people don't fully grasp this. You should not even be investing or talking about rates or talking about average rates of return or interest or any of this until you fully understand and have internalized the Rule of 72. The Rule of 72 is the constant rate of compound interest. When you know the Rule of 72, you can figure out in your head what your money will be in 10 years, how much it'll grow in 20 years or 7 years. It is simple math if you understand the formula, and you need to know it. So let's take a look at how it works. And again, some of you think this is really elementary, but you're going to see by the end of this presentation how every time compounding interest beats the performance of the stock market. And people don't get this, and they've made serious mistakes by not understanding how much more powerful these compounding effects are than the ups and downs of the stock market. So, constant rate of compound interest. Basically, what you're looking at in the Rule of 72 is that if you take any interest rate, you divide your interest rate that you're getting into the number 72, the answer, the mathematical answer, will show you how many years it will take to double your money. So let's say that we're getting a 6% rate of return, and we're going to divide that into 72, and that answer is going to tell us how many years it will take to double your money or your asset base at 6%. In this case, the answer is 12. So let's see how this plays out a little bit. We've got someone and they're 29 years old, and they inherit $20,000 from grandma. And they know they're just going to earn 6% on it every year. So fine. In 12 years, they're going to be age 41, and that would have doubled to $40,000. In another 12 years, they'll be age 53. That'll double to $80,000. In another 12 years, they'll be 65 and ready to retire. And their $20,000 has multiplied once more to $160,000. Good, bad? Well, that's all relative. But the point is, if you know the Rule of 72, you would know exactly at age 29 what your money's going to look like at 65. Now, let's change this out. Let's take a 12% rate of return and see what that looks like if we divide that into 72. And how many years to double our money at 12%? Well, it's reciprocal, so it's 6 years. Now, a lot of people think 12%, you'd be surprised. Again, I know if you're a savvy investor, you would laugh at this. It's amazing the amount of people that would think that 12% interest will give you twice as much as 6. So bear with the basics here. I'm going to show you some advanced data here in a minute that's going to blow your mind when we compare this to stock market performance. But again, if you're age 29 and you've inherited $20,000 from grandma, but now you can get 12% rate on that, then in 6 years, it's going to double to 40,000. And in 6 years, you're going to be 41. It's going to double to 80,000. And 660,000 at age 47, and with 320 and 640. And the ultimate result here is at age 65, you've got $1,280,000 that you've grown from the base amount of $20,000. Now that's 8 times more. So the other thing to understand about the rate of compound interest here and the rule of 72 is 12% is not over that period of time, double 6%, it's 8 times more. And the underlying factor is over time, interest rates compounded make a huge difference in your outcomes. Okay, so now that you understand how interest is compounded and the way that we typically measure that, I want to compare this to average rates of return. Now, whether it's mistaken or not, quite commonly, average rates of return are used in promoting and evaluating stock and mutual fund performance. Now, you know how to do an average. Let's just go back to school. It's very easy. Take the annual returns, year 1 plus 10, year 2 plus 11, year 3 minus 10, minus 7, plus 16. You add these all up, you get a total of 20. So we take 20 and we divide that by the number of years that we're averaging, in this case, 5 years. And the answer is that we have a 4% average rate of return. Very simple. And by the way, the numbers I just showed you were not representative of specific years that the stock market had returns or not. I'm just trying to go over the basics of how you do an average. Now, let's look at this average rate of returns. I've got a little bit of a puzzle for you. Let's just say that if you had an initial investment of $1,000 and it grew at an average rate of return of 20% per year, how much would you have at the end of 2 years? Let's consider any of these that would apply. 1,440, 1,280, $800, or $0. Think about that for a minute and figure out your answer.